If you trade ES or MES with a smaller account, there's a high probability you're holding 3 to 5 times the exposure you think you are. Not because of bad discipline, but because the chart hides the difference in notional risk. A routine CPI print can move the S&P 10, 20, even 50 points in seconds. And on the chart, that movement looks identical. Here's the actual move. ES on the left, MES on the right. Same candle, same timestamp, but not the same notional. ES is $50 per point, MES is $5 per point. Same move, but the dollar impact is completely different. Let's start with precise definitions. ES is the E-mini S&P 500 futures contract traded on the Chicago Mercantile Exchange. It's the primary instrument for macro desks, index hedging, portfolio beta control, and institutional intraday flow. The MES is the micro E-mini S&P 500. It's structurally identical to the ES at exactly 1/10 of the size. Same underlying index, same trading sessions, same quarterly expirations, same cash settlement, same tick structure. Both move in 0.25 point increments. The difference is what the quarter point represents in dollars. On ES, one tick is $12.50. On MES, one tick is $1.25. 4 ticks make 1 point. ES is $50, MES is $5. So if the S&P moves 10 points, ES gains or loses $500 per contract. MES gains or loses $50. Mechanically identical, economically asymmetric, and that asymmetry determines everything that follows. Anchor this to your account because this is where traders discover whether they're oversized. Take a $5,000 account and risk 1% per trade. That's $50. Give the trader standard 12 tick stop, 3 points of room. On MES, that's 12 ticks, $15 of risk. $50 divided by 15, 3.3 contracts. So you can trade 3 MES contracts and remain within the 1% risk band. On ES, those same 12 ticks equal $150 of risk per contract. $50 divided by $150 is 0.33, which means for this account size and this stop distance, ES is structurally incompatible with proper risk management. Quick check, think about the last ES trade. Did the maths actually fit your account, or did you just choose the contract because the chart looked the same? If your account is in this range and you've been trading ES, you've been oversized mathematically, not psychologically. Now, frame the contract using notional exposure, the core institutional metric. If the S&P is trading at 6,800, one ES contract's notional value is the index price multiplied by 50, and that is equal to $340,000. One MES contract's notional value is the index multiplied by 5, and that's equal to $34,000. The key point is that the contract's multipliers are fixed, but the index moves. So your notional exposure rises and falls with the index level, not with your broker, not with your margin requirement, or your account size. Now look at what happens when the index moves 1%, 68 points. On ES, that move equals $3,400. On MES, the same point move equals $340. Look at the chart. The distance is identical, but the dollar impact is an order of magnitude different. That is the real exposure you're holding when you're taking the trade. Margin doesn't determine your risk. Notional exposure and stop distance determine your risk. Now, incorporate margin and leverage into the structure. Assume representative overnight margins, and this will vary from broker to broker. The ES 12,000, the MES 1,200. If you control 340,000 of ES notional value with 12,000 margin posted, your effective leverage is roughly 28 to 1. MES at $34,000 notional with 1,200 posted sits in the same range. So MES is not safer by default, it's simply a smaller contract. The leverage ratio is similar. Now, where traders get into trouble is intraday margin. Some brokers drop ES intraday margin to $500 and MES intraday margin to around $50. That makes the contracts feel cheap to open, but lower margin doesn't reduce exposure. At an index level of 6,800, one ES contract controls 340,000. One MES contract controls 34,000. At these intraday margins, both MES and ES, they jump to roughly 680 times leverage. 340,000 divided by 500 for ES and 34,000 divided by 50 for the MES. Intraday margin increases leverage. It doesn't change the position. So in exposure terms, 10 MES contracts and 1 ES contract represent the same position. If you wouldn't take the ES position, you also shouldn't take the 10 MES position. Institutional traders, they never size positions using margin. They size positions using risk percentage. A typical institutional band is 0.5 to 1.5% of account equity per idea. Position size comes from one formula: account value multiplied by risk percentage divided by the dollar risk per contract at your stop. If that result is 0, the contract is off limits for that setup. That is the 1% rule, and you'll use it repeatedly. Now, apply the same logic to a larger account. Take a $30,000 account and a risk of 1%, which is $300. Use the same 12 tick stop. On ES, 12 ticks is $150 of risk. $300 divided by 150 is 2 ES contracts. That fits the rule. If the trader needs smaller position steps, they can use the MES instead of ES. 20 MES contracts create the same total exposure as 2 ES contracts. But the smaller contract size lets the trader adjust the position in much finer increments. If you cannot size at least one ES contract inside a 1% risk band at your normal stop distance, ES is not your contract. You stay in MES until the maths confirms otherwise. None of this is emotionally based, it's all mathematical. Now place each contract into its natural institutional role. MES excels in skill development, accounts under $25,000, multi stage entries, partial exits, psychological stability, and risk control of repetition. MES lets you practice execution with real fills, real spreads, and real market impact. ES, on the other hand, is the institutional engine. It excels in hedging equity portfolios, managing market beta, essentially your position sensitivity to the broad market, macro positioning, executing large orders efficiently, deeper liquidity, and fast impact when size matters. When a fund needs to neutralize exposure, ES is the correct instrument. When a developing trader needs precision, MES is the correct instrument. The difference is the financial and psychological weight they place on the trader. ES and MES track the same index, but they behave differently because their liquidity structure is different. ES carries far deeper resting liquidity. Large orders sit at every price level, and that depth makes ES more heavier and absorb volatility more smoothly. MES is thinner, the book turns over faster, orders are smaller, and the price can move a bit quicker because the liquidity is lighter. This also affects fills. Fills tend to be steady because deeper liquidity absorbs order flow. MES fills often feel quicker because the queue is smaller and the book refreshes more frequently. Same index, different liquidity, different execution feel. Now the behavioral layer, where most retail losses originate from. A 1% index move, 68 points, puts about $3,400 of pressure on the ES and $340 on the MES. If the overnight margin is around 16,000 for ES and 1,600 for MES, that's roughly a 20% move on posted margin. And if you're trading with intraday margins as low as $500, a $3,400 swing can exceed 100% of that margin. This is the behavioral risk many retail traders underestimate. This is why traders oversize without noticing. Intraday margin creates a false sense of safety. Another behavioral trap is tightening stops simply because ES swings feel large. That does not make the trade safer, it just guarantees more stop outs. Professionals size down, widen stops to match volatility, and keep risk inside their percentage band. Final check, if you've ever added to a losing MES position because you think the size is small, you are drifting towards ES exposure without realizing it. Behavior follows size, not intent. Both contracts trade 23 hours per day, and liquidity peaks during the US cash session. ES usually trades over 1 million contracts per day, and MES trades several hundred thousand per day, more than enough for clean execution. And the spread remains one tick in both instruments during liquid hours. They widen mainly during CPI, FOMC, or thin overnight conditions. And that's all you need for execution planning. There are 4 structural traps that consistently damage traders. Trap 1, treating MES as harmless. 10 MES contracts are equivalent to 1 ES contract. Exposure scales instantly. Trap 2, trading ES without capital resilience. Routine ES swings are large and require emotional stability. Trap 3, ignoring contract rollover. When volume shifts to the next contract, execution becomes thin. Trap 4, relying on intraday margin to justify position size. Margin is a broker policy. Exposure is the structural reality. Continue here, it builds directly on this video.